chart formations. Every technical trader believes that there are a group of probability formations, better known as patterns, that appear in the market every single day. Our job is to watch the market on a daily basis and try to identify this set of patterns early, so that we build a plan and trade around them. Learning patterns will take just a few days to a few weeks. As more patterns you find, the easier it's going to be to do it in the future. Patterns that have a good chance to work in our favor are head and shoulders, double top, flag, triangle, and wedge. There are more patterns, but in my research, these 5 patterns will be enough to give you that early start in technical trading, and they all have a great win rate. Head and shoulder patterns occur when a trend is in a process of reversal from a bullish or bearish trend. Head and shoulder formations consist of a left shoulder, a head, a right shoulder, and a line drawn as the neckline. At the end of the head and shoulder pattern, we should see price reaching at least 80% of the length from the neckline through the ending point of the head. Here we can see how that formation looks like. So we have a left shoulder, head, and the right shoulder. We said we are going to draw a trend line between the ending points of the shoulder, or better to say the starting and ending point of the head. And we are going to call that a neckline. A breakout of the neckline should provide us minimum of 80% of the distance from the neckline to the end of the head. Here is how head and shoulders look in the bearish market, but everything is the same. Okay, now here we have the Euro USD on the 15-minute time frame. What we can see here is a simple head and shoulder formation. We have a left shoulder head and a right shoulder. We also drawn that blue line to represent our neckline. Once that neckline breaks, we can say, okay, it's time to place a trade. And we would look for that 80% of a distance between the neckline to the head high. Here is how we see the head and shoulders in the bearish market. So we see a strong drop down followed by that left shoulder head and the right shoulder. Again, neckline breakout should move us to 80% of that distance from the neckline to the low point of the head. Here's another bearish example of the head and shoulder formation. Left shoulder, head, right shoulder, a breakout. The part here that you should really pay attention is where you are going to look for a head and shoulder formation. A lot of traders will search for a head and shoulder formation at every stage of a trend. But if you want a high probability play, you should look for a head and shoulder formation at the middle to ending stages of the trend only. So early stages of the trend won't offer a decent probability. Let's see another example of the head and shoulders. Again, it's the inverse. So in the bearish market, we have that formation, breakout offered, a nice move higher. Again, you can always try to target a little bit more. But if you want the best consistency, I would suggest to have at least 80% of that neckline to the low of the head in this case to be as your take profit 1, and at that place you can look to move the stop to break even if you want to squeeze a little bit more. Double top is a reversal pattern, and we are going to see this pattern only at the end of the trend. It's made up of 2 peaks that should be relatively equal and a pullback in the middle. At the end of a double top pattern, we should see price reaching at least 80% of the length from the midpoint through to the top. So if you look over here, what we can see is some sort of the M shape. Or if we are trading to the downside, it would be a W shape. In my head, that was always the easier to remember compared to saying it's a double top. I would always say it's a M formation. Now, the point here that you need to take into account would be that it's not always going to be perfect that the top number 1 and the top number 2 are going to end at exactly the same level. In most cases, especially in the forex market being so volatile these days, you are going to see a small difference. And if you have some rules in a way like how much pip you will allow it, you are going to be fine. Of course, if you are trading on the 5-15 minute time frame, I would allow maximum 3 to 4 pip difference. But if you're trading a daily or a weekly chart, you can always allow 15-20 points. It won't make really a big difference. So again, a breakout would tell you, okay, the formation is over. And you would look for what? 80% of the move from that breakout point till the top. To the downside is the same thing, just opposite. And you see it's like a W key, nothing more. Let's check over here. We have the ASEAN price moving higher. And at the ending stages of the trend, we see that M shape. We can say easily it's a double top formation. And at the breakout point, we can say, okay, it's time to look for the short opportunities. And always, like we said, we are going to take only that 80% of the distance from the breakout point to the high or the low, depend on the side that you want to trade. So again, a nice move higher followed by a rejection around the same area. And as you can see in this case, there is a slight difference in terms of the points. So they didn't end at the same level, and that's really important to know. But why I would allow this is because price didn't find a support and move really higher. You see that price tested that previous level and drop away because candle close is much lower. And again, the breakout point would be that confirmation that the double top is over. Let's see another example. So another M formation, another breakout, everything looks perfect. Flag is a pattern that appeared during the middle stages of the trend. Flags look similar to a simple 1-2-3 pattern and need to be made up of swings from the pattern to be regarded as valid. After the formation of complete flag formation, a breakout should continue to move the market in the direction of the larger trend toward the inverse, the 127.2 and 1618 of the entire flag. So what's important about the flag? It's important to know that they will always go against that larger trend. So if you see trend being bullish, like in this case, we are going to look for a 3-wave move against that trend. And what we are looking here would be that breakout point. Because that breakout point will tell us, okay, now is the time to look for a continuation of the larger trend. In this case, that would be a bullish trend, and we would look for the inverse 127.2 and the 1618 of entire flag. To the downside, it's exactly the same thing. You're just looking for a 3-wave move, and that's all. A breakout point will lead to a further continuation of the larger trend. Let's see over here if you can detect a small 3-wave formation. The trend in this case is bullish, at least on this chart. So we are looking for a 3-wave move in bearish formation. So right here, what we see is a 3-wave move down. We can draw that channel to represent that flag formation, and the breakout point of that channel would tell us, okay, price should continue to move higher. And if we draw the Fibonacci retracement from high to low point, we will get that inverse 127.2% and 1618. That would be our targets for the flag. Let's check over here. Again, it's a bullish market. You can pause the video and try to search for the flag on your own. So over here, at that middle part of that trend, we got that 3-wave move against the trend. A breakout point would be that part when we want to start, in this case, looking for the long setups. And again, throwing the Fibonacci is always going to be the same from the high to the low, looking for that 127.2 and 1618 levels. Okay, now let's try to find a flag formation in the bearish market. So now we are going to look for a 3-wave move that are moving upwards. So here we got that 3-wave move, and the breakout is same, a confirmation that the flag is over. Same drawing part, just in this case we will start from the bottom and move the Fibonacci to the top. But again, we are using that inverse 127.2 and 1618 levels. Triangles are the most common chart patterns. Triangles appear in the middle or right before the end of the larger trend. Triangles need to have 5 legs to be regarded as a valid chart pattern. There is always at least one more push higher or lower after a breakout. After a breakout, price should reach the inverse 127.2 and 1618 of the largest triangle leg. So what we are looking here would be a 5-leg formation, where each leg should be smaller than the previous one. That's the only rule that you really need to remember. And at the breakout point, we would look for the inverse 127.2 and 1618 of the largest triangle leg, and that's all. The downside, exactly the same thing. Now, I know you can't have a triangle that have only 3 legs, but in my testing, the win rate on those kind of the triangle is really low, around 40 to maybe 45%. And I don't think we can make any great trading decisions based on them. That's why I would only recommend you guys to learn and understand that 5-leg triangle. So if you look over here on the chart, what we can see is price moving higher, followed by some sort of a sideways move. If you start counting, we got that 5 legs. After we break that upper red line, we can look for a potential trade. And for trading, we would use that 127.2 and 1618 as our targets. Like you see over here on the chart, we drawn the Fibonacci from the high to the low point of the largest triangle leg. Let's see over here. It's a bearish triangle. Price moved lower, followed by some sort of a sideways move. Most time, when you see a sideways momentum, you will spot a triangle formation. The part I want you to think when you see a sideways momentum going on is just to check if there was some decent trend prior to that sideways move. Because like we said, triangles appear in the middle and late stages of the trend. So if that's true, we should see some stronger move. Like here, we got a decent drop lower prior to this 5-leg move. So then a breakout would definitely give us that 127.2 target easily. Let's see over here. We've seen a spike higher after a little bit of consolidation in the market. And yeah, if we count, we will get that 5 legs. Each leg is smaller than the previous one, so everything is fine. And we can move and say, okay, this looks like a triangle. And I can probably look for a long place when the upper trend line breaks. Again, for a target inverse 127.2 and the 1618. Wedge patterns appear at the end of the trend and signal a potential reversal. Wedges look similar to the triangle pattern and need to be made up of 5 swings formed in the pattern to be regarded as valid. After a complete wedge formation, a breakout below the trend line should give us a pullback to at least the 50% level of the larger cycle. So, as we can see over here, definitely this looks similar to a triangle formation. The only difference between a wedge and a triangle is the direction of when we are going to see this kind of the pattern. Triangle will develop against the trend, while wedge will develop in a direction of the larger trend. And then a breakout point would be that key to say to us, okay, there is a good chance that we are going to see a trend change, and we can look for a 50% pullback of the previous trend. Here's how wedge look in a bearish market. As we can see at the Aussie dollar 1 hour chart, price was moving higher from 30th of May all the way till 4th of June. And at that ending stages of the trend, we can see a lot of choppy movements. We just drawn that 2 lines to represent that wedge formation. But before we say it's fine, we want to see if we can find a 5 legs. In this case, that's true. And at the break of that lower blue trend line, we can say, okay, there is a good chance that we are done with this bullish trend and we can start thinking about the short plays. Let's see, we are trading lower here, and at the late stages of the trend, price started to become a little bit choppy. And again, we have a 5-leg move. Look like a wedge. Once we break that upper trend line, we move nicely higher. So that's the time when you want to start thinking about the long setups. Here is another example, dollar Swiss franc. A nice bullish trend from 7th June towards 18th of June, maybe a little bit more, 19th of June. And we can see a little bit of triangle formation developing in a direction of the larger trend. So in my view, it's always going to be a wedge. And a breakout point would tell us, okay, there is a good chance the trend is going to change soon. Patterns are key for successful technical trading. The higher the time frame where you spot the pattern, the higher the probability of success. Every pattern can be confirmed with indicators to get a better results, and one should attempt to use them in combination with other systems for better success rates. We are going to cover patterns much in greater depth in a later training, so stay tuned and practice spotting them as much as possible.